Trump. I'm your moderator, Chief Marketing Officer of Numerics, Jim Jockle. A lot of debate around Basel right now in terms of the rules that are forthcoming, and the Trump election has kind of fallen right into the middle of that. So today in this discussion, we're really going to start to drive the conversation and get to the points of what, when, and how. And I think by the end of this discussion, our goal in this is really to address the questions of what do I do now and what do I tell my boss? Because I know there's a lot of conversations going on right now, a lot of noise in the news media in terms of potential overturn or revamp of financial regulation. So today we're really going to kind of drill down into what's going on as we know it and create what things should be watched pending the incoming administration. Joining me today from Greenpoint Global, which is an established financial technology and consulting firm operating for over the last 15 years, is Sanjay Sharma, Chairman, and Jeb Beckworth, Head of Financial Institutions, both who were formerly MDs of RBC in the Risk and Banking Group. So welcome, gentlemen, to this discussion today. I'm so happy you can join us.
Thank you.
Thanks, appreciate it.
So Jeb, let's start with you. Give me the 30,000-foot Basel. Why should we care right now?
Well, so Basel is when people think about Basel, they think about BCBS, and BCBS has the sponsorship of all the banks around the world that represent 95% of the GDP. And BCBS is the authoritative entity around the world for proscribing rules that are then implemented in the different geographies. So it's very important for bank regulation.
So this new Basel IV, as everybody's calling it, has been underway in stages of development for, say, arguably the last 8 years, even probably prior before that. Tell me about the U.S. role and who are the key players from department standpoint representing the U.S. in this Basel Committee.
So there's a lot of noise around this, and there's a lot of talk about DFA, but really the important players, the members for the U.S. in the Basel Committee are entities, and there's the Board of Governors of the Federal Reserve System, there's the President of the New York Fed, there's the OCC, and there's the FDIC, and those are the four members that the U.S. has. Now the FSOC chairman, which is by statute the chairman, the Secretary of the Treasury, also has an important role in the U.S. because they corral all of the U.S. regulators.
So who sets the tone of the four? What is that interrelationship? Who sets the tone? Who should we be watching?
We should be watching all of those because they are all independent people and they're all independent bodies, and that's what makes this a little bit more complex than just saying Trump can unilaterally deregulate the global financial system, which seems to be some of the themes around here.
Okay, so Sanjay, let's jump into that question or statement around complexity. Give us the overview of how complex this actually is. I mean, it's not a flick of the pen, it's not going away.
Banking regulation is incredibly complex by design because economies are complex. There is to be a question floating around: why are stock markets volatile, or why are markets volatile at all? Is because the world that they reflect is volatile. So banks globally, whether they are large or small, are serving constituencies that form the economy. The economies form the global economy. And so there are two schools of thought here. One that prevailed almost up to the crisis was that markets decide, banks know what they're doing, and let them create their own independent risk systems, independent risk methodologies, independent capital computation methodologies. Yeah, there you go. That was before the crisis. And the markets will determine banks are smart and they know what they're doing. On the other hand, the other school of thought is that there's got to be standardization so that the systemic regulator or the lender of last resort has an idea of what's going on so that if there's a crisis brewing, they can measure it. And so Basel in the 1970s came about and said, look, if we are the bank for international settlement, we need to know what is the banking system of Singapore versus what is the banking system of the US. So you need some standardization. So standardization is good, but banking systems are incredibly complex. Banks are incredibly complex, and that is the underlying theme here.
So, Jeb, we touched on the roles of the agencies, but it's not broad sweeping. A new administration doesn't come in, everybody just doesn't disappear overnight.
Right.
There's key appointments, but there's also key legacy players in some of those roles that continue to have influence. Give us a little light of who stays, who goes, and how does that change the tone?
So it's really interesting. So It just so happens that a lot of these appointments, all these appointments are generally staggered, but a lot of these appointments happen to be coming up in 2017. So the Trump administration is going to have a significant role in replacing a number of these appointments. Obviously Janet Yellen is the president of the chair of the Federal Reserve Board of Governors. That term expires in January 2018, but her actual term expires several years out from that. So she's liable to be at the helm of the Federal Reserve Board of Governors for quite some time. Other key players, for example, the Department of the Secretary of Treasury is obviously going to be a Trump appointee, and that is going to be leader of the FSOC. That's going to be setting the tone for U.S. regulation. It also helps that he comes from the House, so he's going to be setting the tone not only for the Trump administration, but also for the legislative branch as well.
So arguably that's going to be the key area to watch in terms of that tone set. Who's going to be coming in Treasury? Because obviously you've got Yellen, you've got Thomas Honig still staying within the FDIC.
Yes.
He's been very outspoken in terms of higher increased capital charges for the banking institution.
Yes.
How much play are the legacy players going to have in terms of influence of the incoming individuals?
Well, so I think that makes the November meetings really important, right? The November meetings in Chile, where the Bank for International Settlements is going to be meeting
For
also
Basel III.
for Basel III.
Exactly.
There's a real push, it seems to me, for legacy players from the Obama administration, as well as a push from Europeans. The Bundesbank just came out recently with some public statements that they want to get something done in November. So it makes it a real push to get some of these issues, for example, with FRTB and some of the other things that are out there on the table done before the new administration comes in.
And so there's a push that you can see the push, but it is not like the appointment of a Supreme Court justice, which is mostly a domestic U.S. issue. And we can say, well, we can wait and things like that. This is an international body that is has been planning to meet in Chile for a very long time. And suddenly you say, because we have an administration change or the change of tone, let's postpone this meeting. Let's figure it out later on. I think that's going to be tough.
So one of the questions, though, is, so Basel committees come out ahead of these meetings, which are November 28th and 29th in Chile, and their chairman has come out and said, we're working intensively to wrap up the reforms on time. Arguing the other side, right? And as we were talking about this before, we kind of laughed about it, was, are they trying to push this through? But I think the key point would be any new Trump appointees would have limited influence if the new rules are finalized prior to the inauguration and incoming administration. So what do you say to those who say Basel's trying to push this through?
Well, you want me to take that? All right. So I would say it's kind of ironic, right? Because these are rules that have been in place, been in the works for at least 8 years since the financial crisis. There's been an enormous amount of QIS and negotiation, multilateral negotiation across many countries. So the idea that this is a rush or a push after 8 years of intense study and negotiations.
But Sanjay, let me turn to you. Barclays analysts came out to their notes in their clients last week that if the Basel Committee fails to deliver the package of new rules on time, U.S. influence on negotiations could start interjecting into that regard.
Yeah, so but the point, there's a big note there which says if. And so if the negotiations fail, then clearly it can be up for grabs. But right now, I think our view, I don't know, Jeff, you share this, but our view is that it will be a very hard call to say we are not going for this, or we are postponing the meeting itself, or that we haven't arrived at a conclusion, or that we are not going to ratify and release the standards. I think that would be, because I think that, as Jeff, you pointed out, the preparations have been going on for a very, very long time. Right. And so I think for us it will be a surprise.
And I'm sorry, just to interject. I mean, the counter to that could be that people might say is that, look, when Basel III was coming in and Basel II was coming in, there are many jurisdictions that said, well, why should I be implementing Basel III when the U.S. is still trying to implement Basel I or Basel II? So there has historically been a delay in terms of what Basel gets what Basel promulgates in terms of rules, and what actually gets implemented as legislation or law
Within the nations,
within the
within the countries,
jurisdictions.
yes, that's exactly
There's a
right.
difference though with Basel IV, because Basel IV, in particular FRTB, which is the heart of Basel IV, has a date certain that all of these have to be.
And it has a will language rather than a should language.
And it has a will language rather than
and
should
so it's
language.
very differently worded, by the way.
It is.
The FRTB document, which we might discuss later on, is very differently worded, and it has a deadline that by this date it must be implemented, and that's a very different tone that we've noticed.
So let's dive into the process, right? Because again, today we really want to go back and say, what do I want to tell my boss?
Yeah.
I'm empowered to answer that question.
That's right.
So the debate, as I mentioned in the beginning, is right now the rules as suggested and proposed, and as we're waiting for this FAQ, are somewhat impose higher capital restrictions on European banks versus other jurisdictions. Obviously, the goal is kind of a level playing field, standardization, as you said. So let's assume Chile goes great, things happen, rules are finalized prior to a Trump election, but yet there's still disparity, or is there another QIS after that? How does that process work?
That's part of regulation. That's part of any regulation. So I think there are two complexities here. One is how much capital, which is in the headlines, which is, should I be able to, would I have to raise new forms of capital or higher levels of capital, which will prevent banks from being in certain businesses. The second aspect of this, which is not talked about as much, is the complexity of imposing these rules. And I'll give you Volcker as an example. So Volcker was a pretty straightforward example. It said, okay, ban all proprietary trading by market makers or whatever else. But the point is, when you went to implement it, it became a nightmare for the regulators to interpret what Volcker is and how to prevent it. Because whether 1 second of a hold period for a bond trade means that this is a proprietary trade. So to summarize, there are two areas here. One is how much capital and how do you compute it? And so there is noise about the complexity of FRTB, for instance, the implementation issues, but the headlines are in how much capital, because that affects the economy per se, that affects banks' capital, that affects their management as well.
Absolutely, and I think the other thing that's really that you can't ignore right now is the political angle to this, right?
Yes.
Because the regulators absolutely want to have the headlines going in that there's no increase in capital, that what we're really doing is we're just harmonizing the rules across the world, so there's no chance of regulatory arbitrage. That's the real crux of what they're concerned about. Now the reality of that is that given what Sanjay just talked about, the mechanics of implementation you're not going to know whether we truly are going to have increased capital until this is actually implemented, which is going to take some time.
And let me jump back to, if I may, let me jump back to the notion of regulatory arbitrage, and let's compare it to the pharmaceutical or the airline industry. So there is a formula for aspirin, and you say, or Advil or whatever else it might be, and so you're supposed to manufacture according to those standards, which are regulations, and it's an FDA-approved drug. You cannot change a molecule. If you're flying in a 747 or an airplane, Airbus, the plane is certified. It's according to the standards. You can put a new skin on it, you can change the seating configuration, but you cannot change the avionics or the hydraulics and things like that. When you come to regulatory arbitrage, banks are creatures, economic entities that are paid to innovate as well. They're paid to take risk, right? Which is intermediation. So regulations also have to take into account in this industry in particular. There is innovation, and so there's regulatory arbitrage. And how do you prevent that forever? That's an impossibility. But the point is, you prevent it and make it visible. I think that is what regulators are trying to do, and that is a challenge.
You bring up an interesting point of this debate in terms of regulation versus politics. If you think of Trump, but we're also seeing other sentiments in Europe from European politicians as well, as people need access to capital, right? I can't get money, banks aren't lending, the restrictions are too high, I need a mortgage, FICO score has to be,
illiquidity in the bond markets and everything.
All of that. So where's the balance now, right? So obviously we're not. I think consensus is, DFA is not going to go away. Things are going to be moved on the edges. Basel IV, it's not going to go away. Maybe there's different challenges in implementation, but in this global need right now, in terms of get capital moving again, how does this all start to play out, or how does this take form, where you do have some very hard line in terms of standardization and capital restrictions being imposed by regulators?
Well, let's recognize a couple things. So there's a lot of talk about DFA, and DFA means a lot of different things. Dodd-Frank,
yeah.
and there's a lot in Dodd-Frank. But when we're talking about implementing global standardized regulations, the regulators, writ large, but primarily the Federal Reserve Bank in a prudential sense, and Federal Reserve System in the U.S., has already the authority to write rules that are consistent with the Basel Committee. So there's no legislation that needs to happen in order for that to happen. What does need to happen, of course, is, what could happen is you have legislation that takes some of those powers away. I don't see that happening, but that's, of course, a possibility that people at the leadership level are going to be concerned about.
One of the pauses that we've kind of come to see out of European policymakers is the concern of implementation, right? So, let's just say FDIC, nothing fundamentally changes, rules get applied. However, implementation is a different element in terms of local jurisdictions and local standards. Could you see a potential imbalance or regulatory arbitrage opportunity if those between jurisdictions, between countries, if the EU goes one way, US goes another, UK now goes its own way? How does that play out, and how do you watch
that? The devil is
that?
absolutely going to be in the details, and there's a lot of details and actually conflicts that need to be ironed out in all of this before it gets implemented. And that's something that I know all of the key players are very concerned about in terms of regulation. Nobody wants to have a race to the bottom. Nobody wants to have regulatory arbitrage. But these rules are so complex, and banks, as Sanjay said earlier, are so complex that it's really going to be inevitable that there are going to be some differences. We can talk about some of the specifics without going into, we can talk about the RTL and the differences between the glossary and the appendix, and we can talk about all the different things that still need to be ironed out, some of which we've talked about in the paper, some of which we'll talk about in the book. But there are going to be areas for regulatory arbitrage when this is over.
Yeah, but I want to bring in one point though, James and Jeff, is the challenge of the local or domestic regulators, and we saw that in Dodd-Frank. Is that legislation is written, and then you say, okay, now you implement it and you supervise it and you make sure that nobody breaks the rules, and if they break the rule, deal with the consequences. And so in Basel it gets even more complex, because Basel standards come from Basel. A regulator, is New York Fed, is represented, but it comes to the supervisors and the rule setters, so they have to interpret that and say, this is the rule that I'm setting, which is, and they are not necessarily the same, but they have the interpretation of this rule, and then that rule becomes less or more rigorous, and then you have to figure out how you implement it across these banks. Fine, but then it says, how do you measure this? How do you observe this? And then the intellectual question for a regulator is it helping my risk supervision, or it is not? Sometimes things become opaque. Some rules are so opaque that you say, well, why is this rule there anyway? And this is the question. So the supervisory challenge in bank regulation is an underappreciated. We always say regulators are bad, whatever else, but they have enormous challenges for doing that.
Well, one of the questions that has now come up is, obviously the anti-Wall Street tone in the U.S. elections still exists, but in some have argued that it's definitely been more muted, and that maybe people are starting to forget.
I think so, yeah. I would say so, yeah.
And I'm thinking, who are the winners and losers here, right? I think I've heard some arguments that bulge bracket are still going to be under the scrutiny just because of their size, just because of the Lehmans and whatnot of the past. But it's the supranationals that have a real opportunity where they're may not be beholden to the regulatory burdens. Arguably, perhaps they don't have the exposures. But they might be the ones who are potential winners in this. I mean, what are your thoughts?
Well, if you look at the bank stocks would certainly indicate that they have a lot less burden now than they did, before November 8th.
Well, there was a quote there, though, which says that the markets are priced 4 years of the Trump administration in 4 days.
Yeah, that's true.
Okay. So I think
That's true.
So I mean, you got to live with that as well. So there
Yeah.
might be euphoria, and then the reality might set in. Right?
Look, there's a lot of challenges that the bulge bracket banks have, but I think most of that was priced in, as Sanjay says, to the market before the election, and the election is priced in like a whole sweeping change of this stuff going away in a new Trump administration. I don't think it's going to happen quite that fast. Some of the challenges, you just think about it. I mean, you've got subsidiarization rules in the U.S. It would be the IHC, the Intermediate Holding Company rules, that create complexity in terms of your corporate governance structure for these big banks. You've got the bigger the bank, the more systems you have. You've got multiple different trading systems in these banks. You've got multiple different data sets. You've got multiple different algorithms that all need to be harmonized. And I think that's a theme that's going to go across all of these different banks. Those are easier to deal with if you have a smaller bank.
Yeah.
One question I do have, though, is, how, in the U.S., how meaningful is any of this anyway, right? Do you think about this argument, right? If you looked at, a lot of the bulge bracket firms, there has been a significant shift in terms of traditional core banking. Dodd-Frank came in place, and now we're moved all to wealth management, right? That's the future. I want sustainable revenues. I don't want peaks in volatility. And you've seen that growth go from 5% of the balance sheet to 55% of the balance sheet over the last 7-8 years. To what extent is this all noise?
Well, so I think a lot of this is not just noise. I think it's real. So if you look at some of the things that are going to be potentially rolled back under a new administration, if you just look at Paul Ryan's website, or you look at Donald Trump's website, you look at Jeb Hensley's website, all of those talk about rolling back the Department of Labor rules that affect wealth management. So that's something that a lot of the big banks have gotten into. They all talk about wanting to increase lending capacity and increase the ability to lend. That's something that's echoed, particularly the lending capacity is echoed in Europe. And Europe is much more bank dependent than capital markets dependent. And that's going to be a huge thrust for implementation of the new rules that the regulators and the politicians may not see eye to eye on, but over time is going to be very, very important from a political standpoint.
But just to interject there, the pendulum. So you're right. The let's say that the seasoned folks who have seen a couple of crises have not forgotten this. We came to the brink of disaster, but the pendulum is swinging the other way, and naturally it should. Because Dodd-Frank came as, you can call it, a reaction, and say, how could we have let this happen? So legislators also have responsibility of public funds and say, well, we are bailing out these banks and all that, which we are not designed to do. And so they don't want to do this again and say, oh, we had all these rules and now we are bailing out the system again. So there's the give and take. I mean, that's what I want to answer that question.
So let's argue the systemic state fee right now, right? So Federal Reserve Bank Minneapolis President Neel Kashkari has come out with his own plan, the Minneapolis plan. Embedded in the 50 pages was a pronouncement that said he estimates that regulations imposed since the financial crisis have reduced the chance of another crisis from 84% to 67%. His plan would take it to 9%.
Right.
With Basel IV, why is this plan coming up? And that's not a really big move of the needle if you subscribe to his numbers in terms of a safer economy here.
So I love the precision there. I just wonder.
Right, yeah.
67%. It's just amazingly
If you were sitting in the middle of a crisis and you were saying, "Oh, I've reached the 67 limit," I think I'd be all
Right.
like, "No, I was wrong."
Right.
Because we are concerned about the tail anyway, right? Yeah.
Right. Exactly. It's like you go out and it's raining and it's 67% raining.
Yeah. Okay. Yeah, I'm fine. Yeah. Don't worry about that.
So I don't mean to. You can jump in it if you want, but my personal view is here's a guy that, like many of us, lived through the financial crisis right at the center of the storm, and so he's got a very unique perspective. He doesn't have a perspective. He doesn't have a voice at the table in terms of the international discussion. He will have a voice. He's got a tenure that lasts quite a long time as the head of the Minneapolis Fed. But he is not on the Board of Governors of the Federal Reserve System. He's not likely to be appointed to the Board of Governors of the Federal Reserve System anytime soon. So he doesn't have it's an interesting perspective, but I don't think it's anything that's going to be implemented anytime soon.
Yeah, but I have kind of a philosophical or a deeper perspective on this. So if you look at the book to market multiples of the banks right now, most of them are sub 1, and I think Deutsche Bank is trading at a fraction of that.
It was.
Now you come back with the Kashkari plan and say, oh, by the way, you are now going to, at that multiple, you're going to raise $100 billion of capital for the system, so that I can move my needle from 67% to 9%. Shareholders are going to say, hold on for a second, there's more capital, my returns are lower, right? Because you have more capital you earn, so you have a price earnings multiple. And from that perspective, you're going against the grain of the markets, because markets want more return with less capital, which means that you impose more rules, capitals will become more and more scarce and more expensive.
So, to that end, so let me just kind of let the table set here right now. FRTB, is it going away?
No,
I'm asking you.
So FRTB, I'll come back. I'm sorry. I thought because your question was blunt, like, is it going away? I would say my answer is no. Why is it not going away? Because this is not a backlash policy. This is not Dodd-Frank, which said in 6 months we got to design this. FRTB has been in the works for 8 years. FRTB levels the playing field in a very systematic and methodical level. Is that this is how you should standardize the risk of market participation. And so you had lending rules. So Basel I, Basel II were more focused on lending, which is default risk. But what we saw in the markets in the crisis in 2008 was that you might have your lending portfolio, but if that lending portfolio is treated as a trading portfolio, when you're trading CDOs and what you had, or mortgage-backed securities, then credit and markets become kind of one and the same. And when you have a disaster, bond portfolios and loan portfolios trade the same as markets. So FRTB is a rule, a guideline for, or policy, or regulations for markets that is the first time is really standard, and there's a reason why it's called
fundamental review.
Means they have gone from the bottom up and said this is how you should look at, and it's also quite an improvement from Basel 2.5 because it does remove some of the inefficiencies of Basel 2.5, 2.5. So it does bring, or it's a very good step towards standardizing market risk.
Yeah, and I would agree with almost all of that, I guess. I would have there's a couple things that I would just say that are going to be important to FRTB. One is that it's going to be there are some metrics that I think still need to be done. I think that there is going to be for example, what is the floor of the standardized approach to the IMA? Not to get into too many details, but I think that there's the basic things like the definition of the boundary between the banking book and the trading book. Those kinds of things have to be there. The standardization has to be there. This is all going to be though re-looked at in the context of increasing lending, increasing liquidity in the bond market, and a different perspective going forward, not just from the U.S. but I think globally, towards promoting growth than looking at systemic risk.
But let me dig in a little bit deeper into the FRTB. So FRTB is not just a new way of measuring risk or assigning capital. FRTB also defines how your risk organization will look like. So there are guidelines for desk level model validation. The models have to be common across from the trader to the CFO level, which means that there is commonality of models. There is a standardized test which says that either this approach or this approach is applicable. It's flexible enough as well for banks to pick standardized approach or internal models approach. But it is I wouldn't call it a sweeping guideline in a negative sense, but I think that it's a transformational guideline that is going to force banks, for better or worse, to standardize their systems, which is long overdue, by the way. Because these complex systems, banks have their own designs all over the world, and it becomes very difficult to assess. And it moves away from VAR, which was the standard before the crisis, and it showed us that it doesn't capture the tail risk, to expected shortfall. So FRTB, in our perspective, is it's an A-tier fruit of labor. It is well written, but it does have its pockets. It does have its pockets that need a lot of analysis, and the implementability of this from a computational perspective is also in question, because in some ways FRTB is theoretical, because they say, well, you're going to run 50 scenarios or what have you, and we are pull our hair out and say, well, how are you going to be able to do that? What kind of CPU capacity you need? So, but in terms of its dimensionality, it is multi-dimensional, and it's transformational, by the way.
So I guess long gone. I always remember when GM was downgraded and was potentially coming out of
General Motors, you mean? Yeah.
Was coming out of the Lehman Ag. There was 50 guys in a room with a spreadsheet. What does this desk have? What do you have? Are you suggesting that's no longer good enough?
Because let me just tell you. From our experiences, from my experience, and Jeb, you're on the banking side, but so this is my favorite analogy, is that when you're using an email system, right? Let's say it's Microsoft Exchange or Google or Gmail or whatever else. It has a standard and it goes through. So I send you an email, it goes through. I send an email to a group, it goes through. When you look at financial technology, it doesn't, because you might say I use this code and that language and that model, and all kind of creating the same result, but the mechanism through which it goes is incredibly spreadsheet oriented. You have 10 levels of spreadsheets all over the place, so you need standardization. FRTB is kind of a force towards, and some insiders are seeing FRTB as a catalyst for transformation.
And I think this is going to be a competitive advantage. Banks that are running their capital models on Excel spreadsheets, which you'd be surprised at how many banks are still running big parts of their capital model on Excel spreadsheets, are going to be at a disadvantage. And I think that's regardless of whether FRTB comes into place or not. At the end of the day, and this goes to maybe the final question that we were talking about what would we talk to our CEO about? You've got to be flexible, right? You've got to have a good grasp, and that means having a good grasp on your data. That means having a good grasp on your models, and that means having some transparency and consistency to both. So, regardless of what happens on FRTB, the competitive landscape is going to be changing, both on a local level and on a global level, on a constant basis. And banks are going to want to, and this has been a very tough time, because a tough thing to do historically, because banks have not historically been in a position to increase transform their enterprise servers. That's just not been a winning.
It's a big investment. It could be a debt investment, and
usually takes a lot more money than expected.
And when you're fighting the post-crisis fires and you're Dodd-Frank, you're not thinking about transformation.
Right.
And so this seems to be, and it feels like the folks in Basel have sat back and said, okay, I can create a new quantitative phenomenon, I can create a new quantitative modeling, and I can do that, but you know what? It will become the VAR. It will become the VAR methodology, where before the crisis, if you look at the VAR of one bank versus the other, they were following different methodologies, and so they were not comparable. So if they're not comparable, so I'm the New York Fed, and I'm looking at the VAR of Bank A and VAR B and the broker-dealer VAR, and I say if they're not comparable, then how do I know what their risk is?
Just we're having a discussion. So if we have a baseline, where's the differentiation? Arguably, even a commodity can still be an experience, but why do we have so many gas stations, right? I can get my peanuts here or there from one to two different corners.
Let me answer. Let me answer that question, if I may.
Go ahead.
Is that so? Let's talk about the peanuts and gas station. It's so which gas station in peanuts is more successful? Which is more efficient? So let's say that first of all, the notion that banks will become commodities, I think, is it's a little bit far-fetched, because they have their constituents, they have their clients, they have their depositors and the lenders and stuff like that. But the point is that If you are able to deal with regulation that makes your risk management system more robust, and you're doing it efficiently, and you are ahead of the competition, which means that, let's say Bank A has a, what do you call the legacy enterprise system, and they wrap this FRTB or whatever on top of it. It's expensive. It's rubber bands all over the place. So your competitive advantage now is not necessarily capital, because that might be standardized, not necessarily client relationships, but one of the most important aspect of your capital advantage is how efficient and flexible you are. If you're efficient and flexible, because regulatory change is a constant. I mean, that's what we are, I think, gearing towards. Regulatory change is a constant.
That's
and I think as you come towards the end, as you ask that question, I think we'll be able to address it a little bit more.
And that answer is going to be different for different sized
That's
banks,
exactly
right?
right, yeah.
So if you're JP Morgan or Deutsche Bank, you're going to have the wherewithal to build your own systems, and you're going to have the problems of all of that, right?
That's
The
right,
complexities
yeah,
of all of
yeah,
that.
yeah.
If you're a local bank and you do 5 FX trades a year, then you're probably going to be looking to an outside source for that kind of efficiency. But either way, you want to have the efficiency and transparency built into your models, and it actually may be easier for that second local bank to be able to leverage a third-party system than it will be for the massive global bank to be able to harmonize all the different legacy systems that they have in place.
So, obviously with change and volatility, there's always opportunity, and one of the things that just hasn't been discussed, right? So, obviously we're delving into Trump, and for those, if you're interested in the paper that Sanjay and Jim have published in terms of Basel and Trump, it's available on Numerix.com, and it's a great paper, very specific in terms of expectations.
Thanks for the advertisement.
No problem. But one of the questions I have, right? So, if you think back to the thinly veiled issue-based election we had in this country. Part of the rhetoric that was coming out of the Clinton camp was we're going after the hedge funds, right? And we're not talking, that just disappeared off the docket. We're changing DFA and whatnot.
Yep.
Obviously, there was starting to be a momentum in the U.S. in terms of moving beyond banks. We've seen regulations in terms of Form PF, but arguably what we saw normalizing the banking system was going to start moving onto the buy side. Can we anticipate a cliff like that's going to stop, and maybe some of the repeals of Dodd-Frank, we can now start going back into alternatives? And is there a boon in this element of the economy that it's just we're all kind of sitting here not thinking about going, but hey, let's go over here.
I think that is going to hinge largely on who gets elected, who gets appointed to these key roles, right? So I think it's going to be nice to speculate about all that. We'll probably know a lot more in the next 30 days about who's going to be appointed.
So it's going to be the tone at the top,
right?
But I would just say that it takes time and a lot of work to push it through the system, legislation itself. The executive order is one thing, but then you say, well, we have this legislation and we're going to repeal this part of the DFA and the other part of the DFA. It takes time, and it takes a lot of work as well. So I think we shouldn't have any quick expectations.
I mean,
but the rhetoric of elections generally goes away anyway, right?
Yeah.
That's a constant.
Well, at least until everybody has turkey on
Yes,
Thanksgiving,
exactly.
and then we're all fine. Then we're going to start
Yeah.
worrying about Black Friday
Yeah.
and moving on.
I do think it's important, though, to look at what can be done immediately through executive order or recension of prior executive orders, and what is going to be a slower moving process through either regulation or legislation.
Right.
So regulation, legislation, those are going to take time. Things that could be done by executive order are going to happen very quickly.
Right. Well, no, that also brings up the arguments at the midnight hour and how much regulation is going to get pushed through.
But the point is, so when you say executive order, so let's say that there's an executive order 1159, it can be repealed at 1201, right?
Yes.
So why would you be taking that back? So pardons cannot be unpardoned.
Well, that's the auto industry about electric cars and still paying on that one. Well, this is good. We're now after 40 minutes. We're having a little bit more fun.
We always have fun with you, Jim.
So we're gonna wrap. We're gonna wrap a little bit and just and table set here again. So going back, what do I tell my boss? Stay the course. Right, let's keep this FRTB team together. We've got to figure it out. It's coming. Maybe there might be changes on the back end of 2019 in terms of the elements or onerous elements of capital imposed. but yet the spirit and execution of systems still
So
has
I
to be in
think I
place.
think that's right. I think you have to. First of all, I think you have to stay the course, because I think that if you don't, the time frames for implementation are just going to crush you if it doesn't come through. Second, again, regardless of what happens with FRTB, it's the name of the game going forward is going to be flexibility and transparency. At least flexibility and transparency within your own organization, if nothing else. So the kinds of things that you're going to be doing for FRTB are also going to be the kinds of things that you're going to be having to do for flexibility and transparency.
Yeah, but
and harmonization.
Let me underscore some of the points there. So there are three outcomes now. One is nothing changes. Nothing changes means FRTB doesn't come in, or bank capital requirement. Let's stick to the basics of bank capital. Let's say that your capital requirements don't change. That's one middle course. The other one, so then you basically business as usual, which is unlikely, right? We agree to that. This is unlikely. The second is that capital requirements increase. Capital requirements increase means you have to optimize your existing capital, shut down or restrict some trading businesses or some lending businesses because you're not good at it, and you can say, look, I don't want to be in this business. That happens after every cycle. Or that capital requirements are decreased. Capital requirements are decreased. Then you have the other question. It's good or bad, but the point is then you say, well, where do I deploy this capital? Either return it to shareholders, or I beef up my capital and increase my trading activities, which means flexibility comes in, which means, for the next 4 years, or I would say for the next decade, the real thing that matters is flexibility, and your cost of maintaining regulatory standards or compliance standards, the cost of that is the key, and that comes with flexibility. If you're not flexible, as Jeb said, then you'll be paying a lot. So let's say, you know what, I don't know what's going to happen, so let me slow down all these efforts. The moment you do that, and then suddenly you come back and say, Chile, Basel is reaffirmed, FRTB is coming online, nothing changed, then your cost of doing that is double or triple or quadruple, as we realized in the CCAR exercise. When banks were doing CCAR, they were saying, okay, it's fine, but when they started failing, then the question was, how much do I pay for it? No limits. Just go for it, because if you don't pass, you won't be in business.
Right. So anybody on transformation team, Sanjay just canceled Christmas. Nice job.
The other part to all this, and going back to the benefits of all this, is that if your businesses now become more transparent and flexible and harmonized, you have a better opportunity to service your clients, right? So if you can keep trading desks around and not have them go out of business because there's too much capital, because you can't monitor them, or because now that you're going to a regulation that's at the trading desk level, and you can't explain to your regulator exactly what you're doing or how you're monitoring it, those are all problems for your clients. If you can be much more granular about delivering those products and those services to your clients, and knowing what the cost of delivery for all those things are, then you're going to be serving your clients much better. You're going to have a leg up on the competition too.
So and this is a tough question. What do you think the regulators themselves are feeling right now in this transition?
I think they're feeling the same thing that everybody else is, right? They're if you look at the amount of work that's coming down the pike for the regulators,
it's incredible.
Think about regulators that historically have looked at an organization at the top on an enterprise-wide basis, and now have to dive down deep into and opine on the individual trading desks, regulatory trading desks of each organization. And so for some, maybe it's 2 or 3. For others, maybe it's 150 or 200 different trading desks.
But this
huge
is,
amount
from my
of
perspective,
work.
this is where you can see the potential impact of a Trump administration. That takes people, that takes resource, and ultimately it takes funding. So I think that's going to be something to watch in terms of the budget process of what comes out and how much is going out to the OCC, the FDIC.
Absolutely.
Are they ramping up? I think that's going to be a critical indicator as it relates to implementation that people should be aware.
Yeah, but from that
That's
perspective, so the worst case scenario is that I change the rules. Let's say DFA, this is going away, Dodd-Frank, this section is going away. Regulators, you figure it out. And by the way, I'm cutting your funding.
Right.
Okay. And by the way, FRTB is coming down. is coming down. And so, let me just say a word for the regulators. They always they have a thankless job, because if stuff is right, say, hey, it's the banks that are doing a good risk control activity.
Right.
If stuff goes bad, then hey, you failed. You should have been harsher. And then they have to, and when there is change, the first shoulders are the regulator shoulders.
That's right.
And they have to deal with the banks too. And then there's the notion of regulatory capture. I mean, we can go on and on about regulators, but I think the regulators are feeling, I would think, highly stressed.
That's right. And at the end of the day, it may just be that the regulators, if the scenario that you laid out happens, which I think is a distinct possibility,
Yes.
then it may just be that the regulators end up saying, okay, well, I'm going to have a flow-through method, and I'm just going to do a cursory overview of these regulatory trading desks. That has a potential to lead to problems too, right?
That's exactly
For
right.
exactly, being a regulator is a lot like being a hockey goalie, right? You're not rewarded for the stops,
That's
but
exactly
you are,
right. Yeah.
but you are penalized for the goals.
For the goals. Yeah, that's exactly right. And the other thing is that if you remove it if you remove part of DFA, one part of regulation, then what do? I mean, it's like, okay, you can now fly your own plane. You say, how? Well, you're standardizing an airplane. You say, you can fly this, and you say, okay, you know what? You can do whatever you want. And you say, well, how do I do this? And they say, but I'm still watching you. I say, well, you're watching me against what? And so that's a big challenge. Once you put in legislation, that's why you'll find still, if you go for a mortgage or whatever else, you'll find some piece of paper that was designed 50 years ago, but it's still there.
Yes.
So it's tough to take it away.
And usually through a dot matrix
That's
printer.
exactly
Yeah,
right. Yeah,
So
exactly.
I didn't even know they still
Exactly.
make that paper
that's
anymore.
exactly.
So we're getting to the top of the hour, and I want to thank everybody for continuing to join us through this discussion. So let's turn to summary thoughts at this point in time. Sanjay, your key takeaways. What's on your watch list? Obviously no Christmas.
Good question. In our watch list, that's what we are worrying about again, is change, and rapid change or dramatic change, and how do we prepare for it. The other thing is on our watch list as well is, and is moving away from regulation is the leverage in the system, and talk of even more fiscal measures or monetary measures. And so there's too much leverage in the system, there's too much excess reserves, maybe part of another webinar here. But in other words, there is a systemic illusion right now with so much cash and negative interest rates, which we've never seen. So so that's from the macroeconomic perspective. But from a financial institution regulatory perspective, we worry about banks trading at below 1 multiple price to book. I mean, that shows that markets don't trust them, right?
Yeah.
They don't know what's going on. And so I would say 3 worries. One is, how do you react to regulatory change practically, not by raising more capital, but how do you conform to FRTB? And that's what we are spending a lot of time on. Jeff and I are working on a book on that, coming out probably January or February timeframe. But these are the 3 things: macroeconomic, squeeze and pressure, negative interest rates with that. The second is regulatory change, and third is the banks where they're trading right now.
Yeah, actually, let me just follow up on one thing. You bring up a good point. We're coming up at the end of the year. Arguably we've got 40 days left. We always know there's a annual reset. Kind of mentality going into a new year. What would set the tone positively going into that new year, and what's going to set the tone negatively? I mean, arguably Wall Street bonuses are down. We're already seeing that report.
But bond trading
yeah.
is better though. Bond trading is
Bond trading is
better.
better. So I think bond trading is better. I think that on the plus side, you've got Sanjay's concern about the negative interest rates, the low interest rates. You're starting to see signs of inflation. You're starting to see signs of higher interest rates in the U.S. That's on the back of growth. So you're going to have a stronger dollar. There's going to be winners and losers from that. There's going to be winners and losers from higher rates, because we've been at a very low interest rate for a very long time, and as Sanjay said, the leverage has been free. And so now that leverage is going to be not free, those people that don't have hedges on place, or the bought assets using high leverage are going to be losers from that kind of scenario.
So are we watching the Fed now? Is it a Fed watch?
Possibly,
We've talked a lot about the Fed, but we've talked about it in terms of the prudential standards.
That's exactly
I think there's wide consensus now that the Fed is going to increase by a quarter point. I'm not sure that makes any difference, and it's already baked into the system. I think the interesting thing to watch is going to be the 10-year rather than
Yeah,
the short
that's
rates,
exactly
right?
right.
Because
Yeah.
the 10-year is really what drives the economy. And again, I think that's probably a separate webinar when we want to talk about
Yeah, that's
Yeah.
the Fed and
yeah,
the
and
the balance sheet and all that.
I could debate you on that, but the overnight's
But-
a negative. Yeah,
Oh, this would be
whatever,
fun.
yeah.
I don't know, stick around for another hour.
Yeah.
But I think that all those things are in the whole are going to be good because it's going to be, global growth is coming. We may be generating the seeds for new bubbles down the road, but that's going to be down the road.
Yeah, that is, the proof is in the pudding. Well, we will see. But coming down to banks and how you're managing them is the flexibility is the key. I mean,
I
could
think
there
that's
be a
right.
crisis? Could there be a China bubble? Could there be something else? Geopolitical situation right now, we didn't talk about that. So, I come back to what Jeb said is flexibility. It's flexibility to measure and manage risk at an efficient and economical way. I think that is the competitive advantage of institutions in the next decade.
Absolutely.
That's what I would say. It's flexibility.
You've got to have, and it's the only way you're going to have the speed to be able to react to markets generally, to regulation as well.
Well, Sanjay and Jeb from Greenpoint Global, I want to thank you so much. Your report available on Numerics.com. Basel under Trump, very good Numerics partner and friend of ours. I want to thank you so much for your time and insights today. Obviously, we're going to have a lot more to talk about. I think we'll probably do this next Friday and have a whole new set of things to talk about.